Determining the base probability of a trade to quickly calculate your risk reward. First off, what is base probability? So base probability is taking out all of the other variables of context and only looking at the market from the stop to the entry to the target, with the assumption that the market operates, as the random walk theory would suggest, at around a 50-50 in the long run. When we're talking about trend, doesn't matter here. In fact, nothing really does. The only concern that I have with base probability is where is the stop going to go, where is the entry, and then where is the target going to go. Once I have that information, we can determine the base probability and make sure that it aligns with other external factors to give us an adjusted probability. Now, an adjusted probability, that's where, as an example, you're at the lows of a channel. That adds a little bit. When you're at a structural resistance, if you're looking to short, that adds a little bit. A psychological round number, whatever it is, you get the idea. Any additional pieces add to the base probability to give you your adjusted probability. So an example, let's say I have a pattern setting up that has a likelihood of success at around 40%, and that's based on historical testing. It's obviously not the highest of probability of setups. That's a low probability setup, and because that's the case, I most certainly cannot be entering that type of trade zone as a scalper. A scalper operates in the realm of high probability as the trade-off being high risk. That's a mismatch. It doesn't line up. It's like sticking a circle peg in a round hole. It just doesn't fit. When you're dealing with a low probability setup, but taking it with a high probability approach, there's going to be instances where you're going to take that type of trade, and the type of trade that just doesn't fit, and have it still work. And if anything, those are the dangerous ones, because those are the ones that are going to reinforce the bad habits, really kind of sink them in there. It makes it even harder to get rid of. We always have to be trading in the realm of positive trading math. And if our trade moves outside of that, it's exit time. There's no questions. And keep in mind as well, the math on the trade will be in flux while it's open. Every new candle, every new tick, every new move, every new adjustment can change things. So we always have to make sure that we're staying up with the most recent changes and movements so we don't miss an important change that we may have to make to our trading approach. So looking at an example of base probability comes down to where is the stop, where is the target, and where is the entry. So if my entry point is here and my stop is here, and let's say that distance is 50 ticks, and then my target is up here, and let's say that is 100 ticks. Well, in this case, this would be a 2-to-1 or a 1-to-2, depending on how you say risk reward or reward versus risk. I think everybody flip-flops those. But you're risking half as much as you're willing to make. So this is a low probability situation. Now, why would we consider this low probability? Remember, the base probability is taking out all of the other factors and assuming that everything is 50-50. Why would this be low probability? It's simply because our stop is closer than our target. It's way easier for the market to fall half the distance than it is to rise twice the distance if we're externalizing all of the other factors, right? No context, nothing else, just the distances. If that's the case, assuming everything's 50-50, well, then realistically, this is a low probability setup. Well, that fits now. We have a low probability setup in a low probability area. That's totally fine. I'm okay to take that type of setup because now my trading math makes sense. And just so you can see what I'm talking about when I'm talking or referring about trading math, it's all about the expectancy, and the higher the number, the better. So when I'm looking at, let's say as an example, we're taking a 60% accurate trader. So 60% of the time, they're making 1.5 times what they're willing to risk, right? So if they're risking $100, they're making $150 when they're right. Well, that means that 40 times out of those, right, they're wrong. That means that they're losing 100. So if we take 9,000 minus 4,000, pretty simple math, that's positive. That is a positive math expectancy on that trading, on that trading setup, or whatever that trade happens to be. So everything is pointing to this being totally fine. This is good trading math. That's what you want to see. Now, if we were to look at this as a different way, like as an example, a low probability setup zone with a high probability entry location. That means that I'm going to be wrong 60 times out of 100 or 600 times out of 1,000 or whatever you want to do, but it's a low probability. It's that 40%. So if I'm wrong 60 times out of 100 and my losses are 100, we'll just make it easy, that's a loss of 6,000. Now, if I'm approaching this as a scalper is typically a 1 to 2 inverse risk reward, meaning that they're willing to risk twice as much as they're willing to make. But the trade-off is significantly higher probability. Well, if I'm only making half as much, then I'm going to have some problems, right? If we have 40 of them, that is only taking a win of 50. Well, wait a minute. That doesn't work anymore. We've got some problems. So our losses compared to our wins, that's negative math. If we take the 2,000 minus the 6,000, that doesn't help anybody. That's how you blow accounts out. So that is an example of negative math. When you have a negative math on a trade, whether it adjusted to be negative math because of a new candle or something else, it's time to jump. And that's why when the math has gone out of your favor, it doesn't make any sense to be in anymore, regardless of where the market is. Now, when we're looking at adjusted probabilities, that's where we can go in and say, okay, well, if I want to be a buyer, and let's say I want to be a buyer on a pullback, if I'm buying a previous swing low, this by itself is, maybe a fairly decent setup. We'd give it, maybe a 50-50. But a 50-50 setup, we start adding to that base probability. Where's our stop? The stop's got to go down to the lows. Where's the target? The target would be at least back up to the highs. Oh, wait a minute. No, this is a high probability setup. High probability means high risk. So I have to ask myself, am I comfortable with that? Well, maybe not. Maybe I don't want to risk, a bajillion ticks all the way down to the lows. So then I have to kind of judge how I want to approach this. If I'm going to approach this area with a low probability setup, but it's in a high probability zone, I'm asking for trouble. I have to wait for the market to give me something else to work with so that it's back in alignment with me again. And that way we can make sure that everything is ready to go. Because realistically, being a buyer here this time around would have worked really well. But there are going to be other times where you try to buy that move and you get absolutely obliterated because the stop has to go way down here and you maybe weren't necessarily anticipating the proper trading math. And don't forget as well, when you're going along and you're looking at your probabilities, always make sure to adjust with new information. As an example, this looks pretty range bound, right? We've got some nice bearish movement. We've got 3 lower highs, some pretty heavy bear bars coming down. Got some wick on the bottom, but overall, seems like the sellers, if anything, are probably going to try to push down to the lower area here in the 13,625s. And then all of a sudden, something completely changes, right? If I were a short seller and I were looking for continuation down, this would completely disrupt my probabilities. That would throw everything to the side, which means that it's probably time to hit the exits, and I might need to readjust my trade plan. So always make sure that you're adjusting while the trade is open, just to make sure that you're staying up to date with the current math. And like we always say, stay safe out there. Keep those stops in play and let the winners run. Have a great day. We'll see y'all in the next one. Thanks.